The earnings conference call of Bata India Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manoj Menon, Head of Research, ICICI Securities. Thank you, and over to you, sir.
Hi, a wonderful good morning, good afternoon, good evening, depending on the part of the world you are joining this call from. Representing ICICI Securities, this is Manoj Menon here. I'm joined by my colleagues Aniket Sethi and Karan Bhuwania, representing ISEC consumption team. It's our absolute pleasure to host the management of Bata India Limited for the Q1FY23 results conference call. The company is represented by Mr. Gunjan Shah, Managing Director and CEO. Ms. Vidya Srinivasan, Director, Finance and CFO, and Mr. Nitin Bagaria, Company Secretary. Now, over to the management for the initial remarks, and after that, we'll open up the floor for Q&A. Over to you, sir.
Thank you, ICICI team, and welcome everyone. Good afternoon to all of you. We will directly jump into the presentation that we have already shared with the stock exchanges. We assume you have access. We'll try to navigate through the slides as well as the numbers so that we stay synchronized. Slide number 2 is a disclaimer. I am sure you must have gone through that. I now request Gunjan to take us through the presentation. Then we can jump into the Q&A. Thanks, and over to you, Gunjan.
Thanks, Nitin. Hi, everyone. I am on and happy Independence Day, happy 75th Independence Day. It's a big milestone in India's history. I'm sure all of us are proud of it. I am on slide number 3, which is the index. Basically, it's the format that we have talked about in the past. We'll talk about the business, we'll talk about some key levers and how we have managed to shift on those, what are the highlights, and finally is basically the financials. Moving on to slide number 5. So we have reached now nearing almost 1,900 point of sale. That's a combination of both EBOs and shop-in-shops. We have started sharing a shop-in-shop, and I will talk about that in detail, spread across obviously 800 plus towns. In addition to this, obviously we've got the multi-brand outlets to our distribution vertical. Obviously last quarter we did significantly surpass our ever highest sales in the quarter 1 that just concluded, April, May, June. Sneaker studios got expanded in line with our snooker strategy. I'll talk about that a little more. We keep penetrating deeper through both the franchise as well as the multi-brand outlet distribution segment, and we have obviously made significant progress now in terms of our product offerings, refresh, newness, especially in certain focus areas that I have talked about, and I'll talk again this time. Moving to slide number 7, right, which is the levers that I've talked about in the past to all of you all. Quickly on, I will not go through each one, but progress on many of those. Sneakers, it continues to outpace our overall growth. The sneaker strategy is continuing the momentum and the payoff that we have invested behind it. We continue to invest even more, and while that's one big part of portfolio evolution, there is another piece on casualization. There is also a piece that we are now working upon, which is on basically premium fashion on the ladies' side. Hush Puppies anyways anchors the entire men's side. On expansion, franchise expansion continues. It's another strong quarter. We would like that momentum to continue and maybe even increase further. More about it later. And similarly, our access to potential, which is what that WD percentage is, continues to gain momentum and give us dividends in terms of top-line growth. Marketing investments, there were a bunch of campaigns, right? So the marketing momentum gains. We had done in the December quarter a decent amount of marketing. In the March quarter, we had brought it down a little towards the first half because of Omicron. But this quarter, in the June quarter, we've again seen multiple campaigns actually, and one of our strongest marketing investments. in bringing youth back to Bata, and that is giving us benefits. E-commerce continues momentum, significant sequential as well as year-on-year growth. E-commerce was one engine that has continued to grow year-on-year even during the COVID period, and over that we've seen some decent growth in this quarter gone by. Some significant initiatives on the supply chain side. Customer returns are reducing, signifying obviously a whole bunch of initiatives towards better product quality process-wise, as well as in terms of making sure that defects are identified well in advance. Also, we made our first big step towards regional sourcing, which is getting sourcing closer to demand. Does give us multiple benefits in terms of cost benefits, as well as in terms of faster nimbleness in terms of reactivity to demand fluctuations. Variability on costs. Flexi manpower is something that I've talked about. We made strong strides, more than doubled the flexible manpower in our stores. This is one large initiative, multiple others that are in the works in terms of variabilizing our cost structures. And last but not the least, on talent, process and technology, some big shifts. Now our entire retail distribution centers have gone live with the new technology package, and that will give us ensuing benefits over a period of the next quarters and years. We are looking at a comprehensive technology implementation enterprise-wide, and that is under very late stages of discussion, and hopefully we'll talk a little more about it next quarter. And last but not the least, even the manufacturing system has undergone an upgrade in terms of the software systems. With that, moving to slide number 9. In terms of point of sale, that is what you see in the graph below, which is the bar chart, right? It is split into 3, which is the cocoa, which is red, franchise outlets, which are the ones that is the bar that is marked in black, shop in shop in blue, and the total obviously is total. As you can see, we are nearing almost 1900 points of sale. It's a significant clip up from the previous quarter, which was also an increase. What is also of note is that the increase has happened across the various elements of our network. As I had mentioned to many of you all in the previous quarter, is that our rationalization on the cocoa has come to a reasonable closure, I would say, and now we've seen the net additions on the cocoa also, while we have significantly added franchise as well as shop-in-shop stores. As I mentioned, I see a lot of potential on franchise, and I think there's a chart next. We've also invested in renovations and facelifts across our store network. This year will be our largest ever investments on renovation and facelift. Some of it is optical in the sense that it is also clearance of backlog of the work that we could not do for 18-month COVID period. But all said and done, it's a large amount of work done by the team, and obviously giving us great benefits in terms of response from consumers. Moving to also, I would say that 125 snooker studios, we were 100 plus last quarter, so we keep adding. It obviously leads our overall growth. Sneakers, as I said, has significantly kept on pace. In fact, furthered the gap and therefore driving our growth. Sneaker studios are growing even faster. We plan to invest in this even further, and we also hope to see a store of sneaker studios down the line. Also, we see basically men's dress, especially Hush Puppy, is doing extremely well last year, and that is on the premium side of things. Slide number 10, moving to the next chart, franchise. 20 additions. As you can see in the chart, the last year we saw largest ever net addition of stores at 75. This first half we have already added roughly around 40. We've got a very strong pipeline. I've mentioned this. The kind of demand that we see from potential franchise partners is enormous. It's more a question of our bandwidth, which we are obviously increasing. And I'm pretty optimistic of hitting the vision of 500 sooner rather than later. And we should hopefully see a record year this year on additions of franchise stores. Moving to slide number 11, which is on the multi-brand outlet side. The town coverage, as you can see, is a consistent graph of additions. We are closing towards 1,100 towns, which are mapped directly by us. Our access to potential in terms of the kind of size of distributors, which is a big stride that we've taken in terms of large distributor additions. So So there has been some consolidation, but a large amount of net addition in terms of large distributors, and that gives us an access to almost 40% of the market potential in our estimates. It is led by a concerted strategy in terms of a customized portfolio, which has been something that has, I think, been the key to a sustainable and a competitive growth on this channel. And we hope to continue doing that, along with opening a few more fronts on this front, which is basically on men's as well as on the sports category. Next chart, which is 12, we will on e-commerce. I think it stays at about 10%. It's been almost 3x in terms of contribution on our entire multi-channel e-commerce omni-channel business. Let me remind you, e-commerce for us is a combination of three revenue lines. It is obviously the marketplaces, it is our home delivery, as well as basically our Bata.in, which is our e-store. And all three of them have done resoundingly well. As you can see that even sequentially, the channel has grown almost 70% and obviously significantly over the previous years. As I mentioned, this was one channel that has grown every year. One more key metric for us, especially on our e-store, has been basically in terms of our ability to scale up sustainably, is to manage the complaints. And that you can see has continuously kept a declining path despite higher volumes. And this goes on to show and gives us confidence that we can scale up this channel. Bata.in is by far now our largest store in our store network, if you can consider that an e-store as a store. We have also added 3PL facilities to scale up the digital business, and that is in line with our thoughts on nimbleness in our supply chain and cost structures. Marketing investments on slide number 13. As I mentioned, this has been one of our strongest quarters on marketing investments. We see this as not only our own confidence, but the payback that we are seeing in terms of the investment payback back to us. From a shopper point of view, we saw multiple campaigns. The start of the quarter had the Hush Puppies Neo Leaders campaign. That was the first ever campaign that we had on Hush Puppies ever in our history, and it's given us great feedback. Casual contribution within Hush Puppies has gone up. It has grown much faster, and it tells us that we are on the right track. We also had towards the start of the quarter the fag end of the Unlimited Sneakers campaign, and that I had spoken about last quarter also. We brought about our first campaign with Disha Patani with the 24/7 casual collection, and that has given us good feedback. One indicator is obviously that the average age of women consumers has shown a significant drop within a short period of a quarter, and we look forward to that obviously getting accentuated as time goes by. And I mentioned the categories that have done well. Sneakers, women's as well as Hush Puppies have led our growth significantly. Some of the examples of stores that we have renovated across our network, and as you can see, many of them are littered with the Sneaker Studio concept of ours also within these stores. On the slide number 16, some of the other highlights I mentioned about the retail distribution system. It has gone live. We started this journey about 9 months back, and now the full network on the retail distribution centers has gone live. Net Promoter Score, I've spoken about this. This is a key focus area for us, and that has shown significant improvement at 70. It is a gain of almost 700 basis points versus 2021. And it is not only now in our FOCO stores, but also our Net Promoter Scores in our franchise network is also now very close to this mark, and that's an encouraging sign. It also tells us that we know how to manage scale on the franchise network, or we are learning how to do it well. Franchise engagement in line of that has also gone up to make sure that we understand what our partners are telling us, and therefore we get better at serving consumers and increasing revenues for both them as well as us. We did make an effort, significant effort led by the leadership on corporate social responsibility. There is a concerted employee volunteering program which we started in this quarter, as well as we were awarded by CII for our quality on zero defect. Moving forward to slide number 18. Slide number 17, which is a financial metrics. As you can see, Obviously, the growth is significantly, it doesn't fit in the bubble, but it is basically about 253% over last year, which was impacted by the second wave, and about 7% higher than the pre-COVID quarter one. On the right side, you see the profitability metric. Both of them show the trajectory, which is what we have tried to work towards, which is making sure that we sustainable, profitable growth on a consistent trajectory. And in recent times, that has been our highest profitability, both EBITDA as well as PAT. With that, I come to the end of this small presentation of mine. Over to you all for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Akshay from Fidelity. Please go ahead.
Yeah. Hi, team. 3 questions from my side. If I look at your presentation on
Mr.
slide...
Akshay, can you please be a bit louder?
Sorry. The contribution for franchise and store-in-store is 32% this quarter in terms of number of store count. Could you help us understand what is the contribution to revenue? Is it directionally similar, lower or higher? That's question 1. Question 2 is, you highlighted that online salience has gone up. Could you help us understand as online salience goes up and it's a journey, so it keep going up over the next 2-3 years, how does that impact P&L in terms of gross margins and EBITDA margins? And third is specific to this quarter. Could you just speak about margins? Sequentially revenues are up healthy, but other overheads are up to a similar extent. Just wanted to understand if there were some one-time cost or some resumption of normal costs that happened this quarter, which so I would have assumed that there would be some more operating leverage this quarter from other overheads, but that wasn't to be seen. Those 3 questions from my side. Thank you.
Okay. The first one on contribution of point of sale. This is pertaining to the retail business line. And no, the ratio of contribution of revenue is not in line with the number of point of sales. Naturally so. Shop and shops are significantly smaller. Obviously, it's like one panel, or now we are looking at multiple panels within some of these departmental stores, etc. While we expand the number of doors, we are also looking at multiple panels. But all said and done, significantly lower from a revenue per panel or a per door perspective. A franchise from a revenue perspective is lower, largely because there is also a part of the revenue line that gets passed on to our channel partner from a margin perspective. From a profitability perspective, as I said, it is significantly accretive. So that contributions will be much in line with the store contributions. The second piece on e-commerce. We do see the scaling up. E-commerce is a scale business, along with a few other levers in terms of learning curve. So while there might be a gross margin impact depending on the channel, because within that there is a B2B business and then there is a marketplace B2C business. B2C margins are largely in line with our retail margins. The point is that but however, things like, let's say, depreciation and fixed costs are significantly lower. So our endeavor is to make sure that over a period of time, this channel also equally contributes on the profitability at the EBITDA line, right? Depreciation being another benefit that this channel will have versus Coco. On the last piece, I will hand over to Vidya to talk on the sequential margin.
So margin is approximately down about 1% from March 22 quarter. So that is essentially about a 0.3% is an account of essentially a change in mix, where retail share is a little bit lower in June quarter versus March quarter. Second piece is we had a obsolescence gain in March quarter of about 0.3%, and obviously that is not there this quarter. And so that is kind of causing that impact. And finally, this is also fairly consistent. There is also a product and price impact of about 0.4%. That is, a consistent trend. For example, if you look at the March to June quarter of 2019, you would see, actually a much larger margin drop. So it's essentially a function of the products that make up our business in June quarter versus March quarter.
Specifically on the overhead cost line item, it sort of grown exactly in line with top line. Is it just how we should think about seasonality from Q4 to Q1, or maybe because of Omicron you spend a little, naturally lower on AMP, etc., and that's caught up? I'm just trying to understand that line item.
So I think there are two functions to it. I mean, of course, there's a little bit of a seasonal thing, but two big functions is that obviously we spent more in marketing this quarter compared to the previous quarter because, like Gunjan mentioned in the presentation, we were kind of being very guarded as far as marketing is concerned in the first quarter, in the March quarter. The second piece is that obviously from a rent concession standpoint, given the increase in sales, we haven't had rent concessions. And the third piece is also given the increase in sales, some of the margin expenses which are related directly to sales obviously kicked in. So it's a function of that.
All right. Thank you.
Thank you. We have our next question from the line of Umang Mehta from Kotak Securities. Please go ahead.
Yeah, thank you. Am I audible?
Yes.
Yeah. Thanks for the opportunity. I just had one question. Would it be possible to share the contribution from sneakers and shoes and including power here as well in this quarter, and what would that be in the pre-COVID Q1FY23 quarter?
Okay, I lost you towards the end, but my sense was what is the contribution of the sneaker category and how has it progressed over, let's say, pre-COVID or something. Is that right?
Correct. That's correct.
Okay. So sneakers contributes roughly around about 19% to our turnover, right? It's been a gain of almost 4 percentage points, right? Basically 400 basis points versus what it was pre-COVID. During the COVID, there's a lot of distortion in the mix, etc. So I'll not take that as a reference. But we see that contribution is largely being driven. I mean, you can also do the back calculation, but it's because of a significant delta growth. The delta growth that we had in sneakers in December quarter, where we started seeing the first results of this concerted effort, was about 10%. It went up to about 20% in the March quarter, and the delta growth in the June quarter was about 28-29%. And we feel very robust about this trajectory going forward also. Understood.
And just if I can step one more, what would the contribution of school shoes in this quarter?
So school business contribution would have been roughly around 9% in this quarter, right? So school has been a little frequent for us, while school business has sequentially gone up significantly, right, between let's say March to June. From a 2019 perspective, there has been a little more difference in the behavior from a consumer perspective. There were two elements that were basically manifesting itself. One was that there was spacing out that happened rather than normally it gets punched very accurately between, I would say, let's say May and June. This time there was a little more pacing that happened, and I can sense the spillover that has happened of school business into the subsequent quarter of July, September. The second piece that I think will give us hopefully much better legs going forward on this business is that we anticipated a certain amount of, we have a traditional and a sportier classification of the school business. We anticipated a certain contribution and therefore inventory profile of this mix. And the demand that came in was far outstripping that. So we could not basically catch up to that sportier angle of that mix. And that is something that while we have now basically made corrections, but I'm sure from the next season onwards, we will have a much better mix in place to capture that demand efficiently.
Understood. Thank you so much. And good luck for the rest of the year.
Thank you.
Thank you. We have our next question from the line of Aniket Sethi from ICICI Securities. Please go ahead.
Hi, Gunjan. Thanks for the opportunity. The first question I had was on the ASP growth number of 19%. So can you kind of split it up in terms of the mix benefit which you would have seen from casualization and some like for like price increases? And the follow-up to that is in terms of the inflation which you would have been seeing. Are you covered for that inflation now?
Okay. So there are two questions, but both of them are interrelated, Aniket. The ASP growth has been, I would say, sequentially flat, right? But the year-on-year growth is obviously significant in the range of that. At an overall level at 20%, there is a mixed play that is there in it. I would say that right now, for whatever we see as inflation, we have taken action. As I had mentioned last time, we have also seen obviously 50% of our portfolio that gets impacted because of the GST increase, and that also is a factor in our ASP increases. Right. Obviously, the effect gets faded from a sequential perspective as time goes by. We are basically, as of now, hoping that the inflation, stabilizes, if not declines. But we will have to wait and watch on it.
Understood, sir. Got it. Second, I just want to understand if are there any segments at the bottom end which you are kind of open to consolidate, given the increasing focus on young consumers and casualization. So just want to understand this from the perspective of that maybe the benefits of casualization in the headline numbers could be much bigger quantum in a few quarters.
Okay, so there are two parts to this. The way I see this market is that in the medium to long term, both ends of the market will grow pretty well, or should grow pretty well, right? And it's the kind of brand repository that we have led by Bata. We do feel that we've got a right to play in both the sides. On the premium side, we will experiment with, on the super premium side, we will experiment with a few concepts to beef up, especially on the sportier as well as on the women's fashion as I mentioned earlier, right? So one is that both the segments will grow. In terms of the way it's manifested itself is that we've seen our entry price point basically getting impacted because of the price increase that has happened, and that's the one that we have now made a large effort. We have started seeing some initial signs of it in terms of helping us recoup volumes back, and we will see how that progressively impacts beneficially to us. But I see potential on both sides of the spectrum.
Got it, sir. That's really clear. Lastly, one small clarification which I wanted to check. Do all your newer stores have a sneaker studio, or this is again more of a market-specific strategy you're using right now?
Mostly the newer stores would have, especially in the tier 1 to tier 2 towns, metro tier 1 towns. The franchise need not have it. We are looking at what is the right way to scale this, because 125 stores is about less than 10% of our network. So there is ample way to go before we go down top strata. So, but all new stores that we renovate, in most cases in metros and tier 1 have sneaker studios. And that is how we keep adding every quarter.
Got it. Thank you so much. Thanks, and wish you all the best.
Thank you.
Thank you. We have our next question from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. So my first question is with regards to if you can highlight, what has been the average selling price, both in the retail and the wholesale channel for us, and also if you can highlight, why the online ASPs are declining for us, consistently over the last 4-5 years.
Okay. So one is, I don't know where you got to here, but e-commerce ASPs are actually going up, and even last quarter they have gone up. The big lever, in fact, one of the big levers as we gain scale is to make customized curated collection, which is online savvy, and obviously drives ASPs for us. In fact, the highest ASPs that we have is in our e-store, even compared to our metro store network. And that is something that we have made actually pretty strong progress consciously. obviously to our benefit on economics, etc. The second piece, the first question I think was the ASPs versus retail, etc. So I'll give you a little more flavor. I think our retail in the top, I would say the top quadrant of our stores, which would be metro and tier 1 cities, the top 30 metros in the country, would be in the range of about 1,000 plus. The balance would be in the range of about 800 or ASP, and the distribution business would be e-commerce, as I said, is a combination of the channels, but our endeavor is towards basically making sure it in end consumer ASP is in line with retail, and the distribution business, the ASPs are significantly lower. They are in the range of about 300.
Sir, the reason why I was saying about the online the ASP is declining was just I was referring to the annual report data that has been shared by you. So if you divide the number of pairs sold by the online sales, the ASP is actually come at a lower level of around 572, which was actually around 700 rupees in FY20. So hence I was mentioning to that that the ASPs or the realization per pair in online coming down.
Okay, so that only function of that is basically because you run it through a marketplace business. So if you have a partner, your realized ASP might be lower, but the consumer ASPs keep going up.
Okay. Thank you for the clarification, sir.
And so the next channels, basically. Yeah.
Okay, got it. And so my next question, is with regards to if you see overall in terms of, there has been a sharp price increases both in the, the wholesale channel and the retail channel as well over the past couple of years. But at the same time, if you see on a CAGR basis, our revenues, have just grown by a 2% CAGR versus the pre-COVID or the Q1FY20 levels. So my question is regards to have we seen volume decline both in the wholesale and the retail channel? And if so, what would be the key reasons for this?
Okay. So there are a couple of questions that are embedded in this. One is that one is that we've had a significant conscious strategy towards rationalizing unprofitable stores over the 2-year period, and that shows up in that graph that I showed you. And that, as I said, that exercise has been largely completed. And we will keep on having an ongoing correction, but I think the structural one is done and dusted. And that is why I think this quarter we've had net additions for the first time in the last 8 quarters. And hopefully that momentum continues. That's one. Right. The second piece that is there is in terms of volumes. As I mentioned earlier to someone else's question, we've seen a volume pressure which is largely in the entry price points of, which are in the range of about, 500 plus or minus. And those are the ones that we are now working towards making sure that we re-engineer, make sure that we introduce and gain back those consumers. It's very critical that we want volume-led growth. And as I said, we are seeing early signs of some of the actions that we have taken. We'll keep you all updated as the period goes by and our initiatives start fructifying in the marketplace.
Sure, sir. Thank you, and that's all from me, sir.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Kapil Jagasia from Edelweiss Financial Services. Please go ahead.
So my question is regarding the franchisee stores. We have around 300 plus franchisee stores in the smaller towns. But usually if you see in the smaller towns, the market is very organized. So how successful we have been in these towns with respect to market share gain here?
Sorry, the market is very organized, you said, in the smaller towns.
Market is very unorganized. So would we have gained market share over a period of time?
Yeah. So, there is no syndicated data that tells us in a more concrete way. But yes, for sure, there are many towns where we are the first entry players, right, from an organized retail. Not necessarily so, by the way. So we've got a basket of benchmark companies that we consider as, peers that we would like to make sure that we benchmark on franchise expansion. That shows us enormous potential in terms of where we can go in terms of the franchise network. Let me also clarify that while primarily the franchise expansion is towards the down pop strata, there are also the larger metros that are expanding in the hinterlands, right? And there, hitherto, where we could not make economic sense or sustainable economic sense in opening COCO stores, the franchise model certainly allows us to unearth pockets of opportunity and tapping markets and eventually, hopefully, gaining market share. Does that answer, hopefully, your question?
Yeah, sure. I get it. That was my only question. Thank you so much.
Thank you.
Thank you. We have our next question from the line of Ali Asgar Shakir from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. Based on the channel checks that we do, I get a feedback that on the ground in the stores, Bata, sales is not really as aggressive in terms of pushing business to the customer. So just want to hear your feedback about what we are doing to probably optimize sales at the store level when we compare yourselves with other retailers.
Yeah, sure. So I think there is and your feedback would not be completely misplaced, by the way, Ali. So thanks for re-emphasizing it. It is something that we have worked upon and we will continue to work upon. There are 2-3 things that are of note that I can talk to you. There are multiple things that we have done. One is the piece that I mentioned, which is a question of the incentive structures of basically the store staff. Now a large part of it is linked to basically the remuneration is linked to the outcome at the store, a combination of both hygiene as well as customer satisfaction as well as revenue parameters. The second piece is, and within obviously regulatory constraints that we need to make sure that we comply with as a company. The second piece that is there is with flexible manpower. There is a certain amount of, the sine wave that is there in terms of the kind of footfalls and the busyness in the stores that happens between various times of the day and at various days of the week. And therefore, that piece has gained significant traction. We've more than doubled the flexible manpower in our stores, and that aids the ability to cater to consumers. Last but not, I would say the most important piece is that we have institutionalized and therefore now linking incentives to it is this entire piece of an independent net promoter score survey that we get across our entire store network directly from a third-party agency, and that is linked to the incentives of the stores, etc. And that, as I had given you an update in my presentation, has progressed well. So yes, there's always scope to improve, but there is effort in the direction.
Understood. This is very helpful. Just quick follow-up here. So, what percentage of the front-end staff's remuneration would be variable?
In the range of about 25% to 30%.
Got it. Second question is on the footprint addition. So the number of stores that you indicated have seen quite a strong growth. If I say in terms of area, would you be able to share what kind of area addition we would have seen? I'm just coming from the point of view that you mentioned that the franchise and SIS are smaller stores, whereas we have seen shutdown of the large COCOs. So would the area addition be very different from the pace of store addition that we have seen?
I don't have any answer handy right now, but we'll try and get back to you. Yeah, but your premise would not be wrong. Right? Obviously, the SIS is basically panels, not even a store, right? But it's a very efficient way of catering to consumers and making sure that you're available at the time where the consumer might want to evaluate you. The franchise stores are reasonably large, right? Depending on the town size and the internet potential. But I would say that your premise would be you would not have changed the area dramatically.
Got it. Thank you very much.
Thank you. We have our next question from the line of Trilok from Diamond Asia. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just want to understand is in the previous conversation and prior to post the Q1 results, we had highlighted that you're running in double-digit sort of growth rates, and we ended up the quarter at 7%. So was there any impact that you faced in the June month, or is there a natural phenomena that you guys faced in this quarter?
Yeah, as I mentioned, basically, while sequentially June was absolutely on track, right? However, versus 2019, that reference point of one that you're quoting, we did have basically the school business which I talked about, which did have a moderation impact. So, otherwise, no other big reason.
So essentially, school business would have itself, kind of had the full implications on the lower growth than expected. Is that correct understanding?
I think
I would say that the expectation might be yours, but that is how I would look at it on the reference data point that you mentioned. Yes, sir?
I think it's also spread out a little bit more. Like, if you look at the June 19 or whatever trajectory that we're looking at, school business, like Gunjan mentioned earlier, was between April, May, June, predominantly May and June. And I think we saw the traction of that, but I think a lot of the schools which opened up had also kind of relaxed footwear requirements, at least to start with, and then over a period of time, children were told to wear formals. So I think we are actually seeing schools spreading into July also, which was not the case in 2019.
Yeah, and the piece that we saw, a certain segment, a large segment of that, the demand far outstripping even what we thought was estimates, and therefore our ability to get the supplies back in for the demand that we saw.
Sure. And, with regards to, the comparison prior to COVID and this quarter, when we look at the OPEX, it seems to be, quite high compared to, pre-COVID quarters. Is there any sort of cost, which has been built in now, or is this a normal run rate we should think about going forward, because the profitability seems to be lower than pre-COVID?
Right. I think as far as cost is concerned, I think some of this is also because a little bit of our cost structure is variable. Okay, so we are seeing the impact of parameters in cost structure which are totally linked to sales, whether it be in terms of selling commission for e-commerce, whether it be some of the freight expenses. Our ends have become a lot more variable because we are moving towards a minimum guarantee plus percentage share of sales. So some of that is happening. Okay, so that is what I would largely say. In terms of profitability versus
besides marketing investment.
Yeah, and besides the marketing investment that I talked about. Yeah.
So essentially, there is no meaningful sort of cost bunched up in this quarter. Is that fair understanding versus pre-COVID?
I think apart from the fact that pre-COVID we are talking about 2-3 years of increases, etc. Nothing majorly different as far as cost is concerned, apart from the variabilization of cost.
And would you like to share the percentage of variabilization now versus pre-COVID? Let's say if the cost is 100, 70 is variabilized now versus 30. Any ballpark?
We don't measure it that way. What we do measure is basically, as I said, certain line items that we are working towards. One is obviously, as I mentioned, the retail manpower. The other piece is, third-party sourcing in various parts of our operation. A large part of it being obviously warehousing, logistics, and the other piece is obviously the manufacturing backend, etc., where we can get in a lot more variabilization. So these are various initiatives, and each of them obviously has milestones that will dovetail into benefits as things progress in terms of percentage of sales stuff, etc.
Sure. And the last question, if I may, that
I request you to come back in the queue.
Sure, I'll get back in the queue. Thank you.
Thank you. We have our next question from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So 3 questions from my side. I just wanted to know, are you thinking of exporting, Bata footwear to other geographies of, Bata where they are present? And is that a big opportunity for you? My second question is regarding the SSG. Can you start to share the retail SSG and mix between volume and pricing over pre-COVID? And my third question is regarding online, which one of the participants asked. So if I look at online revenue versus last year or versus pre-COVID, the CAGR is less than 12%, and the growth versus last year is only 5% in absolute online revenue for marketplace and Bata.com. Compared to what you are saying that it's 10%, contribution, but that's more from home delivery. So are you losing market share in online marketplaces for our products?
Okay, I've lost track of your questions. I think the first one was exports. The second piece was
SSG.
SSG and other metrics, and the third piece was on online. Okay, I'll take them in reverse. So basically, online is actually growing pretty fast. So I don't know where you're getting this 5% and 10%. In fact, I mentioned this. Despite the overall growth now being much larger than the business pre-COVID, our contributions are almost 3x. So you can estimate the kind of growth. I have given you the growth that we've seen over even the previous year that we are seeing at almost something like 2.7x, but that's okay, average quarter. But even sequentially, it's gone up by 70%. So it's significantly fast, far outstripping our overall growth. And from whatever year, I think we are, while we are on a very minuscule base, I would say relatively compared to our offline market share. So there's a big headroom there, but we are growing faster than what we get to hear, at least from our key accounts and marketplaces. On the piece on exports, I would say it's a work in progress. There is potential for sure. A lot of our businesses of Bata worldwide are either a large part of their sourcing happens from China, and we are looking at a structural strategy of diversification, and a big part of it is because India is so large and our sourcing base and our manufacturing base is pretty large. So we are looking at it. It requires a lot of structural thinking, including making sure that the right technology, the capability, as well as the right, the tools and the tech packs are all available, including materials. But I don't think that's such a big constraint, but we need to work on it structurally. There is a concerted team that is working on it, and we'll obviously update all of you as we progress in a concrete manner. We should see hopefully a progress over the next few quarters on that front. On the last piece, sorry, what was that question on SSG, etc.? While we don't share metrics on that, but as must be evident to you in terms of COCO stores, we have significantly reduced COCO stores at least versus pre-COVID, right? And therefore SSG is higher than basically our overall growth from a COCO network. The franchise SSG is significantly higher, even on a like-to-like basis, besides the inorganic expansion that's happening.
So just on the volume growth in SSG, by when do you think you can be back to pre-COVID levels in volume terms?
I am hoping for as early as possible, but we will share with you. But we are very hopeful with the kind of initiatives that I mentioned on price points and product re-engineering that we have rolled out, that we should be able to get our volumes growing also. As I said, our endeavor is over the medium term to make sure that it's a volume-led growth for Bata.
Sure, that's helpful, sir. Thank you.
Thank you. We have our next question from the line of Girish Pai from Nirmal Bang Equities Private Limited. Please go ahead.
Yeah, thank you for the opportunity. Gunjan, you mentioned that you advocated certain entry-level price points and you would want to get back to them. Where are we in that journey? That's question number one. Second is, you mentioned that you want to kind of do something on the premium fashion side for ladies. Again, when do you think you could kind of start on that particular aspect? And thirdly, on the distribution side, you said from a product perspective, you would want to look at more of sports and more of men's. Again, when do you think you can probably embark on that? These three questions.
Okay, I will forget your questions again, Girish, so remind me. But on the piece on entry price points, I think we are well progressing on that journey. Obviously it requires some fundamental work in terms of making sure that the product re-engineering is not taking away from the consumer, while making sure that we are able to get profitably the price points back. I would say that we would be about, depending on a bunch of articles, etc., but the shoe line of roughly around 75 to 80 articles, we would be 70% of the journey done. So we will wait and see as and when we complete the journey, it impacts the market, the stores. How does it give us response back? We are very hopeful, as I mentioned now a couple of times in this call. On the piece that you mentioned on, what are the other two questions, Girish, if you can tell me?
the ladies part of premium fashion and on the distribution side, men's and sports categories.
Understood. Yeah, thanks. Right, so on the ladies fashion, so basically there are two prongs. We will be, hopefully I think by October or so, we should have it starting rolling out in stores. We are significantly amping, especially in the top 200 stores, the ladies fashion range on two pivots led by our brands of Red Label and Marie Claire. One is on basically occasion, the other one is on Western office wear. So that's getting amped up with higher ASPs and therefore the premiumization journey on that front. The second prong on that same thing is to try out new banner itself, and that is something that's work in progress. We will update you. But we feel that there is a conscious gap and opportunity there that we should be able to leverage on that front. So that's on that front. The other piece was on the distribution business. Sorry if I got it wrong, but men's is a strength area of ours, led by, I have mentioned the brand Remo. It is, quote unquote, almost a leader in its men's dress segment in that entire multi-brand outlet business. And that's doing really well. It is charging our growth. It is also giving us a significant competitive advantage in terms of profitability. So that is something that will keep driving growth for us. We will dabble in terms of, or we have already started basically in terms of making some kind of initiative towards open footwear on sports as well as closed footwear on sports. And we will update you on concrete progress as and when we make on it. But that is something that we are starting on. The men's clothes is something that we have already done extremely well. In fact, it's a large chunk of our business currently also.
Okay, thank you very much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have a next question from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for again. So my question is with regards to the wholesale business of yours. So, just going by the annual report numbers. So if you see these revenues for your wholesale business is now, in FY20 to come back to the pre-COVID levels of around 3.5 billion odd. Whereas if you see the number of distributors has also increased significantly to 500 plus. So meaning, that your revenue per distributor is not back to the pre-COVID levels as yet. So anything that you would like to highlight on that front?
Yeah, so that number was basically for the full year of 21-22. That was, as you all know, it was a story of, basically two halves in a way, right? So the exit run rate was far higher, and that is what we have seen even this quarter. So that's now significantly growing despite the kind of pricing and GST pressure that have been in that segment. And that is growing pretty well. So I would say the per distributor throughputs would have only gone up on a run rate basis.
Sure. So it would be right to assume that it will be now higher versus the pre-COVID level on an exit basis?
Yeah.
Okay. So thank you. That's all from me.
Thank you. We have our next question from the line of Girish Pai from Nirmal Bang Equities Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Vidya, I just want to get back to the discussion on margins. You mentioned that other expenses were higher at 20%. They were higher at 20% in 1Q FY23 versus 15% in 1Q FY20. So this 20% as percentage of sales is something that you see continuing into the rest of the year and beyond that, or you think that will kind of crunch going forward?
I think I didn't hear properly, but basically you are asking me to kind of project what the increase in expenses would be going forward. I think it'll be difficult for me to comment on that. For making a forward-looking statement. I think what I can say is that I do anticipate that a certain part of our expenses will be linked to the growth in sales, which I talked about earlier as well.
Okay. My other two questions, one is to do with the level of discounting this year versus pre-COVID FY20. Would it be very similar, or do you see that kind of coming off materially because the demand is really robust? And secondly, then if you can give some kind of outlook on growth, because we've seen just about 7% growth versus pre-pandemic 1Q. Is that the growth one should be expecting, or should the growth be in the double-digit territory going forward versus pre-pandemic levels?
Yeah. So markdowns have been slightly on the lower side, largely for the reasons that you yourself mentioned, and we don't see that dramatically changing as a trajectory in the medium term. And on the growth, we maintain a policy of not giving a forward outlook, but we remain optimistic in terms of demand capture and the momentum that we see in the market.
And in terms of the percent, if I can squeeze one more, in terms of percentage of spend on advertising, what would that number have been for 1QFY23?
FY23.
1QFY23. Advertising as percentage of sales. How much would that number be?
Would be about 2.7% or so. For the quarter was? For the quarter was about 5%. Yeah. So for the year, for the previous year, I think we were basically pre-COVID, we used to be in the range of about 2.5 to 3.
Yeah.
And that is what we should normalize to. As I said, we will have an impetus towards investments. So we'll keep marginally creeping it up as we see payback for our various campaigns that I've spoken about.
Okay. Just
compensation for the previous quarter.
Okay. And in terms of the economics of SISs and the franchisee stores vis-a-vis the retail stores on an average basis, what would that be as a revenue per store wise and profitability metrics wise? What would that be SIS and the franchisee stores versus the normal retail stores?
Yeah. So franchise is something that I have mentioned is significantly accretive from a net EBIT perspective, and we want that to be so. It also obviously both franchise and SIS also have long-term strategic implications in terms of the flexibility in the model, our ability to scale up much faster, etc. And as I said, access to hinterlands which otherwise we could not do with the COCO business model. The SIS is something also has a similar kind of a flavor. I would say that it's not significantly different from profitability, but it is it will dramatically improve once we start seeing scale coming through on it.
Okay. Thank you very much.
Thank you. I would now like to hand the conference over to the management team for closing comments. Over to you, sir.
Thank you everyone for joining. Looking forward to interacting with you again. In case there are any further queries, you can direct them to us. Happy to entertain. Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.